Welcome back to the What You More podcast. I'm your host, Quinton Harris. You're dialed in for episode 217. As we get started here, we're going to talk about a couple things in this episode. We're going to talk about the New York Fed. We're going to talk about the credit card debt. We're going to talk about the delinquency rate and why is the foreclosure rate at an all-time low. There's a zinger. That and more here on this episode of 217 at What You One More. Yeah, so let's talk about it here. I'm going to kind of go backwards on this, but foreclosure data came out from the New York Fed showing that it's at an all-time record low for the United States. I like to not hold any punches back on the foreclosure bros that are out there preaching that this is coming and why, but this is just another piece of evidence that stacks up against this, ridiculous tone that's being set out there on the internet. But, I talk about this. Like, if you're listening to people on the internet, which is kind of ironic because, you're listening to me here, but if you're dialed into people that have no depth in real estate, they're not in it, they're not an economist, they don't have models, and they're just saying propaganda to get you either fearful, fired up, or just subscribe. Like, stop, get away from that, because the facts over fears is what's leading the way right now. And this foreclosures, typical foreclosure rate in the United States is going to be somewhere between like 1.7 to 2.4. Like, that's normal, right? We're below that. We're lower than normal. And I think that just kind of jumps off the page here as I look at this data set, and I'm going to have this chart in our YouTube channel at What's Your One More. Charlie, my producer, will put that in there. But take a look at it here, because there's a couple things in this chart, and it's titled The Number of Consumers with New Foreclosures and Bankruptcies. Now, those two things go together because typically it may be the bankruptcy before the foreclosure, or the foreclosure may be included in the bankruptcy. There's just numerous things that can happen, but typically you see the bankruptcy kind of lead the way. More bankruptcies, the foreclosures happen. And in this graph, we go all the way back to 2003 from the New York Fed, and you see this high-level ramp up of bankruptcies. And it's pretty crazy. I mean, from Q1 03, there's a significant rise of about 600,000 bankruptcies that were filed to Q1 of 05 that just crested, right at the million. So you had about over a 50% increase there. And so that was kind of this aha moment, looking back at it, we can see that now. When you're living in the moment, you don't really see it, but you go, dang, like, of course foreclosures are going to happen. Look at that wave of bankruptcies that led the way. And you got to know not every bankruptcy includes a homeowner, right? So you could be a renter and file bankruptcy. So you're not necessarily going to see, a bankruptcy lead to a foreclosure, but you're going to see a trend line that's there. And so going back from Q1 03 to Q1 05, you see this rapid ramp up, right? So then that suggests years, months, quarters to follow, you'll start seeing that foreclosure increase as well. And that's exactly what happened. You go into that Q1 of 05 and follow that ramp up to the peak of Q2, Q1 09, and it's the exact same curve. While again, it's not, one for one, the curve is the same. And so, and then you see like another wave of bankruptcies behind that, because probably what happened during that time, like a lot of things, the courts got tied up because of the amount of filings that were being taken place. And sometimes some people got put in foreclosure, and to avoid that, they would file the bankruptcy. So there's a lot of reasons as to why bankruptcies went up after that, but then they level off. Where I'm going with that is this. In order for this foreclosure wave, right, this wave that we hear about, this could happen, you have to see those waves of bankruptcies kind of lead the way. This is another leading indicator. It's ridiculously low, and it's flat. And so is the foreclosure line. That's funny. So this is another example, during the holiday season, as you're sitting around with family, when someone brings this up, this is right here. All you need is this graph. Just say, let me get my phone up and show you something I found out at the What You One More podcast. There's this guy, Quinton Harris, on there that talks about debunking this all the time with facts over fear. Just pull this graph up. I mean, you can't argue with it. And it goes all the way through Q2 of 2024. This is the November report from the New York Fed. So I thought that was something that I kind of wanted to lead with here on the show. The other thing I've talked about, probably maybe on 10% of our episodes, I talk about the credit card debt, right? And I talk about the concern I have on the credit card debt. And I still have that concern. Now, one of my guests, Logan Matashami, that was on the podcast, Logan came on here and essentially said, hey, I'm not so concerned with that, because we think a bulk of that credit card debt, and by the way, it's over $1 trillion, right? That was my concern, is it hit new levels. He said, I'm not so much worried about that, because that's an age group leading the way. And his suggestion was that was a younger age group leading the way in credit card debt, the 18 to 35-year-olds, and that the bulk of that is with them, not necessarily the homeowners on the other side of that. I thought that was interesting. And, to his point, he did nail that. But I do think those are future homeowners, and that was one of the things I talked about with him, was that, but those are future homeowners that could end up impacting themselves of buying houses and kind of like really strapping themselves with these additional payments, especially as the rates are elevated the way they are. The thing that's kind of, I guess, astronomical to me on this chart, and again, this is the second chart on our YouTube channel at What You Want More, was the credit limits and balance for credit cards and home equity revolving lines. Look at the increase of limits of, this means like, for example, you have a $10,000 credit card and your limit's $10,000, right? And then they increase it to, let's just say arbitrarily for this conversation, to $12,000. So you had a $2,000 increase in that limit, but you're only putting like 1, 2, 3, 4, maybe you're putting $9,000 on there. Well, now they increased it, right? The likelihood of them increasing it is usually with the people that aren't using it as much, so they increase it. The amount of credit availability, it is so high that literally it's off the chart. And when I say it's off the chart, I mean the amount of credit availability is on credit cards, specifically, only credit cards, is literally cresting the chart at $5 trillion, meaning that we've got $1+ trillion, just shy of like 1.1 trillion in debt, but then you've got $5 trillion of available credit card debt. Now, the reason I'm going to point that out and the reason that's astonishing to me is because the highest it's ever been prior to the COVID era was 2008, right? And I talk about the concerns I have in the market, and the concern is in the consumer credit market. I've said that. It's not in the housing market. It's in the consumer credit. Now, one of the things I like to point out is the reason I think these limits are happening, and this kind of bodes to Logan's comments, is that the main users of credit cards right now are between 18 and 35. I don't think they have this limit availability necessarily. I think the bulk of this availability has been given to the people that might be like 38 plus, 40 years old plus, because they're not using credit cards as much, right? And they have more capacity to pay those down. But this bodes the thing that Jamie Dimon said this time last year. And we all know who Jamie Dimon is. Jamie Dimon is like, he's got the pulse on the credit market. I mean, he's the CEO of JP Morgan Chase, one of the biggest, if not the biggest, credit card servicers. Their data they have is unbelievable. Said this: there is a tidal wave and a hurricane brewing in the consumer credit market. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. How much higher is this credit card debt going to continue to go and grow? And that eventually is going to catch up with some homeowners or future homeowners more so than the current homeowners, because then the next graph I'm going to pull up is the percent of 90-day delinquents by loan types, right? And so what they do is they break it down based on student loans, credit card debt, mortgage loans, auto loans, and then revolving loans, right? And the revolving is going to include home equity lines and credit cards. And so, revolving is going to be separate. We have a credit card one on here. I want to make sure I clarify that. Home equity line is basically a credit card secured by your home, but it's separate, so they pull it out independently. Where we're going with this is that mortgages and home equity lines, which is a second mortgage, they are at the lowest levels, right, of delinquencies, like lowest levels. Auto loans are the second highest. Student loan debt is because of deferment. It's literally right there with mortgages. Autos are the second highest, but I mean, they're really probably like 4.7%. Not that bad. Credit cards, off the chart, and they continue to go up. There's a trend here. It's not like it's getting better. It continues to go up. And these are 90-day delinquents. 90 days means you haven't made a statement payment in 90 days. In 3 billing cycles, you haven't made that payment. Now, that number is literally very close to the height of 2009. Very close to the height you'll see on this chart. And this is the market I continue to say, hey, listen, this is where we're going to see a potential, collapse if you are going to see one, right? It's going to be in default rates of credit cards, which isn't going to affect housing, by the way, but it would affect the consumer credit market. But to Logan's point, it might only be that select group, right? We don't know yet, and we'll find that out as the reports come out. But I go back to, again, those are future home buyers. Those are people that could be homeowners down the road. And I'm going to talk about that in our next episode, why I think that's relevant and important. But the last thing I want to leave with on this is that, when you look at foreclosures, you typically look at credit scores too that go with that, right? FICOs in particular. Because if FICOs are trending down, right? If FICOs are coming from, let's say, very good to poor, if there's a trend of that happening, you could kind of argue, well, hey, there's starting to be some slip ups here. And the next stop is foreclosures, right? I'll tell you where I'm going with this, because we monitor credit scores. And if the credit scores continue to be good, and they're not going down, they continue to improve, that means that people that are doing home loans have good credit scores. And that's maybe not your credit card problem. And that kind of actually backs up Logan's statement that he made on our show here. And as I look at this graph, there's a couple things that pop off on this mortgage origination by credit scores. The amount of mortgages that are being done right now, which are down, right? So if you wanted to say that there was basically like the mortgage market is going through a depression, I would agree with that, right? Transactions are down. They're not up by any means, but the prices of the homes are not coming down, but the transactions are down. And you could argue maybe it's a price thing. We just did a whole podcast on affordability, price. What is it, right? But what I will say is this report clarifies one thing that I think is really important. The FICOs are healthy in America right now. They're not going down. They're not getting worse. They're actually doing very well. And in some cases, they've actually improved over the quarter. That's a really good sign of opportunities to come, because as a mortgage guy, as a real estate person, I focus on what future availabilities are there for the consumer. And when the scores are healthy like this and there's opportunities, that's going to give us a good indication of when these rates do come down, then this market does make a turn for more transactions, we're going to have more available buyers to take advantage of that in this market. And that kind of goes towards that whole musical chair thing that I've been talking about for some time, of seller list, they become a buyer, and the cycle goes on and on until you essentially run out of transactions or inventory, which we saw happen in first quarter of 2022. We could see that repeat itself again, maybe not as crazy as it was during COVID, but I would venture to say it's going to be, between the refinances and the purchases, there's going to be a lot of opportunities there. And these credit scores on this report suggest that. I always love going through this New York Fed report. I think it's highly underestimated. And, it's one of the reasons why when it comes out each quarter, I kind of bring it up on the show and talk about it, because we're following trends and they're continuing to happen in the credit card market. We're seeing the delinquency rates go up in the credit card market, but the foreclosure rates are an all-time low. And you know how excited that makes me when I open that up and it's like, there it is. Told you. And it's great to see that. So I'm very excited that trend is continuing to happen, and that, again, we're in the equity positions that we're in America. It gives us a great opportunity for this real estate market when rates start to cooperate with us. And that's the million-dollar question here. But the last thing I'll leave you with is this. We talk about market movers. I thought this was interesting. I don't really talk a lot about stocks on the show. That's not my wheelhouse. That's not where I live. But I thought this was interesting because I always have followed, and I grew up in my college world. I was always taught that Warren Buffett, all his principles, be greedy when people are fearful, fearful when people are greedy, and greedy when people are fearful. I'll get it right in a minute here. But I was always taught those things, right? Boy, is he doing that right now? Is that what's happening right in front of us right now? You take a look at what he's done and what he's compiling in cash, and he's reducing his holdings and his stocks. I'm going to put this chart in there and I'm going to leave it at this. But if you look at Berkshire Hathaway cash pile swell to a new record, it's huge. And it literally is a sign to me. We talk about asset bubbles. It's a sign to me that the market mover is making some moves. And are we in an environment right now where he's saying, be fearful when people are greedy? I don't know. I'll leave you with that. Check this graph we have in our YouTube channel at What's Your One More. And thank you guys for tuning in. If you like what you're hearing, share this podcast. Please 5-star review it. Go to our YouTube channel and subscribe. Leave us some comments. We always love what you put on there, good, bad, or indifferent. We appreciate the feedback. And I absolutely will try to respond as quick as we can. We're starting to get more comments. It's harder to do that. But thank you guys for all of the input you're giving us on there. Until the next episode, we'll see you at What's Your One More.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one lap